Was there any single cause for Black Monday 1987? Imagine a day when stock markets around the world suddenly plummeted, wiping out billions of dollars in value in just hours. That day was October 29, 1987. But was there just one reason behind this chaos? Not quite. The truth is, many factors came together like pieces of a puzzle, creating a perfect storm that led to the biggest stock market crash in history at that time. Leading up to that day, the stock market had been on a rapid rise. The Dow Jones Industrial Average, which tracks the performance of 30 big American companies, had jumped about 44% in just 7 months. Investors started to worry that stocks might be overvalued, and a correction was looming. This built a sense of unease, even though the market kept climbing. At the same time, the United States was dealing with economic issues. The country faced ongoing trade and budget deficits, and interest rates were rising. These concerns made investors nervous about the strength of the economy. The US dollar was weakening, which added to worries about international financial stability. The international community was trying to stabilize currencies through agreements like the Louvre Accord, but doubts still lingered. Another big factor was the rise of computer-based trading. During the mid-1980s, automated systems started executing large trades very quickly. These programs could trigger sell orders automatically if stock prices fell to certain levels. On Black Monday, these systems kicked in and caused a cascade of selling, making the decline even faster. Portfolio insurance was also a new strategy used by big investors to protect their holdings. It involved selling futures contracts when stock prices dropped. But this strategy backfired during the crash because it meant more selling as prices fell, which pushed the market down even further. This created a vicious cycle of fear and selling. Psychological factors played a role too. As prices started to fall, more investors panicked and sold their stocks. This fear spread quickly across markets worldwide, starting in Asia and spreading to Europe and the United States. The market was also affected by events like the expiration of options and futures contracts, known as triple witching, which increased volatility. Plus, some government announcements, like threats to devalue the dollar, added to the uncertainty. All these elements combined to cause the crash. No single cause can explain what happened. Instead, it was the interaction of economic worries, technological trading strategies, investor fear, and market conditions that created the perfect storm. Black Monday teaches us how complex and interconnected financial markets are, and how innovations meant to manage risk can sometimes make things worse during a crisis. It also shows the importance of quick responses from central banks and regulators to help stabilize the economy and prevent further damage.